All right, welcome to Talk Tickers. Today we're digging into Cabot Corporation, that's ticker CBT. And folks, this is a fascinating one. Their latest earnings report, well, on the surface, it looked like a total disaster. But the market? The market absolutely loved it. So what's going on here? Let's break it down. So here's the big question, right? Cabot's revenue missed the mark by over $40 million. I mean, that's a big miss. Usually, a number like that sends a stock into a nosedive. But instead, it jumped more than 10%. How does that happen? What on earth did investors see that the rest of us missed in that headline number? Well, that's the puzzle we're gonna piece together today. Okay, let's dive right into the numbers because this is where the plot thickens. On one hand, you've got the bad news. Revenue came in at $849 million, a full $40 million shy of what Wall Street was looking for. Ouch. But then you look at the other side and, surprise, adjusted earnings per share, or EPS, hit $1.53. That's way better than the $1.40 estimate. So you've got this huge disconnect between the top-line revenue and the bottom-line profit. And that right there, that's our first big clue.
So to really get what's happening, we've got to pop the hood and look at the engine. See, Cabot isn't just one single company right now. It's like a tale of two completely different businesses operating under one roof. You've got the old school legacy side, and then you have this new, exciting growth engine.
Let's start with that legacy business. It's called reinforcement materials. Now, this is Cabot's bread and butter, historically speaking. They sell something called carbon black. It's a super important ingredient that makes car tires tough and durable. But as you can see here, this traditional core is really struggling. I mean, look at those numbers. Earnings before interest and taxes, or EBIT, is down a whopping 22% year over year. And volumes, they're down 7%. This right here is where that big revenue miss is coming from. And it wasn't just that they were selling less stuff. The problem was even bigger. They were getting squeezed on price, especially in the West. Think about it. Demand for tires is down, you've got more competition from imports, and boom, the prices they could charge dropped by 7 to 9%. So you've got this nasty combination, a real double whammy of selling less and getting paid less for what you do sell. Okay, so that's the gloomy part of the story. But now let's talk about the other side of Cabot. While that old tire business was struggling, their new growth engine, battery materials, was just, well, it was firing on all cylinders. Look at this. Revenue absolutely exploded, jumping 39% from last year. This is what got investors so excited. This is the future they're betting on.
And check this out, this isn't just empty growth for growth's sake. We're talking about really profitable growth. This business has a 22% EBITDA margin over the last 12 months. That's a healthy number. So what you're seeing is Cabot building this incredibly valuable, high-growth, high-profit business right next to its older, slower one. And that, my friends, is the real source of all that optimism we saw in the stock price.
Okay, so you've got this split personality, right? One business is struggling, the other is absolutely soaring. So the big question is, how is management handling this? What's their game plan? Let's dig into their playbook.
For that legacy business, the plan is pretty straightforward. It's all about being smart and efficient. The CEO, Sean Keohane, put it plainly. He said they're looking to rationalize capacity. In simple terms, that means they're probably going to shut down some of their older, less efficient plants. Why? To match their production with the lower demand, which helps protect their pricing and, most importantly, their profits. It's a classic, smart move for a mature business. And then for the future of the company, this is huge. Management made a point to highlight a new multi-year deal they signed with PowerCo. Now, if you don't know, PowerCo is Volkswagen's big battery company. This is a massive, massive win for Cabot. It basically locks them in as a critical supplier to one of the biggest car companies in the world, just as the EV revolution is taking off. You really can't overstate how important this deal is. It's a true cornerstone of their growth story. So what about the road ahead? Well, management's guidance was actually pretty solid. They tightened up their forecast for full-year adjusted earnings per share, now expecting something between $6 and $6.50. They also said they're going to spend a bit less on big projects, what we call capital expenditures. And that sends a great signal. It says, hey, we're pouring money into our big growth opportunities, but we're being really disciplined and careful with our spending everywhere else.
And the best part? They've absolutely got the cash to pull this off. The company is a cash machine. It generated $126 million in operating cash flow just this quarter. And with that cash, they're doing two things. They're investing in the business and they're rewarding their shareholders. We're talking $52 million in share buybacks and another $24 million paid out in dividends. That's a sign of a very healthy company.
All right, so let's bring it all home. Let's connect the dots and finally answer that question we started with. Why did the stock soar when the revenue number looks so bad? You know, it really all boils down to what we call a two-speed narrative. The market, the investors, they basically looked right past the weakness in the old tire materials business. It's like they just ignored it. Instead, they put all their focus on that incredible 39% growth in battery materials, those juicy profit margins, and that game-changing deal with PowerCo. In short, Wall Street is making a very clear bet. Cabot's future isn't about tires anymore, it's all about batteries. So where do we go from here? What's this mean for the next few months and even further out? Well, here at Talk Tickers, this is our take. Looking at the next quarter, Q2, we pretty much expect more of the same. The old legacy business, yeah, it's probably going to stay a bit weak, but the momentum in battery materials, that's going to keep roaring ahead, and it's what will drive both the story and the profits. As for the stock price, we think it'll probably hover around these new, higher levels for a bit, while the market really lets this new growth story sink in. So, with all that said, our rating on the stock is outperform. The EV battery story is now the main event, and we think the market is going to keep rewarding Cabot for making that pivot. And of course, just a reminder, this is not financial advice. You should always consult with a qualified professional before making any investment decisions.